The IRS just released their new tax brackets for 2025, which is why in this video, I want to go over what these new tax rates look like so you know what to expect. And then I want to go over how you could potentially pay less money in taxes legally as a licensed attorney who is not your attorney. So make sure you stick with me through the end of this video. Now I want to start by addressing the elephant in the room, which is we have a new presidential administration starting in January, and any changes that this new presidential administration makes is not going to go into effect until 2026 in terms of your taxes. This is what the tax rates look like. These are the numbers if you're filing as a single person. These are the numbers if you're filing married and jointly. So what does that look like? If you make under $11,925 as a single taxpayer, you're going to pay 10% of your income in taxes. For every dollar that you earn between $11,925 and $48,475, you're going to pay 12% of the income in taxes. Up to $103,350, you're going to pay 22% of the income in taxes. Up to $197,300, 24%. $250,525, you're going to pay 32%. For up to $626,350, you're going to pay 35%, and then over and above $626,350, you're going to pay 37% of your income in taxes. Now you got to remember, these are marginal tax brackets. So if you get a raise from $100,000 a year to $105,000 a year, that doesn't mean that suddenly you're going to end up with less dollars because you're paying more taxes. That means the more dollars that you earn are going to be marginally higher taxes. So if you're making $105,000 a year, that means that for the first $11,925, you're going to pay 10% of your income in taxes. Then for every dollar that you earn between $11,926 and $48,475, you're going to pay 12% of that money in taxes. And then for every dollar that you earn between $48,476 and $103,350, you're going to pay 22% of that money in taxes. And then for every dollar that you earn between $103,356 and $105,000, your new income, you're going to pay 24% of that marginal amount of money in taxes. That's how marginal tax rates look. The second big change that we're seeing in the tax code is that you're going to get an increase in the standard deduction for 2025. Here's what that looks like. If we take a look at the 2024 standard deduction, as a single taxpayer, you qualify for a $14,600 standard deduction, and if you're married filing jointly, then you could qualify for $29,200. But next year, it's going to go up to $15,000 standard deduction for the single taxpayers and $30,000 for the married filing jointly taxpayers. That means that you get this deduction standard. And if you want to qualify for more deductions, then you'd have to itemize more deductions than $15,000 if you're single, and more than $30,000 if you're married filing jointly. That includes things like a mortgage interest and charity donations. You'd have to donate and have more mortgage interest deductions than these amounts to qualify for the itemized deductions, because otherwise you just get this deduction right off the bat. Now that I've laid the foundation on what's happening with tax rates in 2025, let's get into the fun stuff. How can you pay less money in taxes? Now, we've been covering this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. It's completely free. It's read by more than 250,000 investors every single morning. So if you have not read Market Briefs yet, I got the link for you to join for free down in the description below. Let's assume that you're a husband and a wife married filing jointly and you're making $100,000 a year, and now you want to figure out how you can pay less money in taxes. So let's go through the scenario. We know that in 2025, you as a married filing jointly couple get to qualify for a $30,000 standard deduction, which means you're going to have $70,000 worth of taxable income. Now, I'm not going to bore you with how you actually calculate your tax rate because you can just do a quick Google search to figure out that answer. I want to focus in on how you can actually lower your taxes. But based off of this, you're going to pay around $10,400 in taxes. Yes, I rounded the numbers a little bit, but it'll make it easier to understand. Now, in order for you to pay less money in taxes, you have two options. Either you can lower your income, that way now you qualify for lower tax rates and you pay less money in taxes, or you can work to increase your deductions, that way you have a lower taxable amount. So let's break both of this down. If you want to lower your income, you have two ways to do that. Number one, you can ask your boss to pay you less money, but that's not very fun because now you ultimately have less money. I do not recommend you make less money just to keep more money in taxes. Because at the end of the day, that means you're foregoing $1, that way you can keep 50 cents. It doesn't make any sense. So you don't want to lower your income, but you may want to figure out ways to lower your taxable income. I'll talk about that in just a minute. The second thing you can work on is how you can increase your deductions. Now, we talked about this just a second ago. This is your standard deduction. This is what the government gives you. In order for you to qualify for higher deductions, you have to have itemized deductions higher than this. Now, if you work a job, now your itemized deductions are kind of limited. It might be things like your mortgage interest. It might be things like charity. And that means you're going to have pretty high expenses if you want to qualify for itemized deductions high enough to qualify for bigger deductions. And you may not want that depending on what your income is. Because if you're just ramping up your expenses, but your income's not that high, yeah, you might have a lower tax bill, but you might not have money to eat. So let's go a little bit deeper. This is where you want to look for things like tax-advantaged assets. That's things like rental real estate, that's investment real estate, investing in stocks, and building your own business. Because the reality is our tax code is very long. In fact, here's a copy of the Federal Income Tax Code. And what you'll see is that it's about 2,000 pages long of this 8-point font of very detailed things. Yes, I keep a copy of the Federal Income Tax Code in the office, but if the taxes were so simple that you just make money and then take the standard deduction, then why would you have so many pages of the tax code? And the reason why is because what the tax code works to define is how you can qualify for more deductions and what really is your income. And that really applies to people that are using these tax-advantaged assets, not people that are just relying on your W-2 salary. Because if you just have your W-2 salary and then your standard deduction, none of this really applies to you. I mean, maybe a page or two applies to you. But when we get into this stuff, that's where the bulk of this book comes in handy, because now we're getting into the more sophisticated deductions, the more sophisticated opportunities to potentially pay less money in taxes. So let's talk about these three things, that we understand the different opportunities out there, and maybe you'll find something right for you. Now, of course, although I am a licensed attorney, I am not your attorney. So if you have specific questions, please talk to a licensed advisor in your area. And if you own a business, or if you're investing in real estate and you're making over $250,000 a year in income from these types of assets, well, then you can consider getting a free consultation from my partner accountant at CommonWealth if you want to learn more about them and see if you can qualify for a free consultation to learn more, to see how you can pay less money in taxes legally. I got the link to how you can do that down in the description below. The two tax benefits that I want to discuss with real estate include depreciation and 1031. So let me show you how this works. Let's assume that I'm a real estate investor and I go out and I buy this single family house for $200,000 and then I rent it out for $2,000 a month. When I rent this property out, I have expenses. So although I make $24,000 a year in rental income, I have to then pay my expenses, and I'm gonna assume that I have $14,000 in expenses, so I have $10,000 a year in profit. This is the money that's in my bank account at the end of the year. I'm not going to go through the real estate investment analysis. Let's just assume that I make $10,000 a year in profit. This is how much money I have in my bank account at the end of the year. Now, depreciation says I get to tell the IRS, hey, this property is 1 year older. And because it's 1 year older, I deserve a tax write-off. But the way that depreciation works is that you get to take a factor of how much you paid for the property, not the land, the property, and get to deduct that against your profit. So let's assume that your accountant says, yeah, it looks like you paid $40,000 for the land and $160,000 for the building. If this is the case, you take this $160,000 you paid for the building, and then you can do what's called straight line depreciation. What that means for single family homes, it's different if we're talking about multifamily and commercial buildings, but for single family homes, that means you take this $160,000 and you divide it by 27.5, and that means you get to take about a $5,800 tax write-off for doing nothing except owning a property that's now 1 year older. And so now you get to tell the IRS, hey, I made $10,000 of profit, but I'm only going to pay taxes on $4,200 worth of income. This is the base style of depreciation you can take. This is called straight line depreciation, and this is nothing fancy. This is the basic level of depreciation. Now, if you get more sophisticated, you might be able to go and say, I want to do something called accelerated depreciation. Now you're going to accelerate how fast you depreciate the value of this property. And now maybe year one, you can take a $20,000 loss, hypothetically. So this is situation two. So you made $10,000. So you have $10,000 in your bank account, but you tell the IRS, I lost $10,000. How much taxes do you pay on a $10,000 loss? Nothing. But this is where it can get even more sophisticated, because let's assume you're also working a job and you made $100,000 in a year from your job. Well, what the IRS says is this is what's called a passive loss. The $100,000 that you made from your job is called an active income. Normally, you cannot deduct a passive loss against your active income. However, there are a couple exceptions. If you make under $100,000 a year, you can take up to a $25,000 passive loss, which means I can own this $200,000 property. I can make $10,000 in profits. I can do this sophisticated accounting and tell the IRS I have a $10,000 paper loss, although I have $10,000 in my bank account. And then because I make $100,000 a year or less, I can then take this $10,000 paper loss and then deduct it against my income. And even if I made more money and I no longer qualify for the standard style of deduction, I can get even more fancy. If I made $1 million a year, hypothetically, and then I have this loss, I'm not going to qualify to take this passive loss against my active income. But what I could do is I could say, I am a real estate professional, or my spouse is a real estate professional. And because one of us are real estate professionals, now we can take this passive loss and deduct it against my active income. You can see it starts to get very complicated, but this is where you want to have a good accountant on your side that can help you find and understand how the tax code works. But at the core, what I want you to understand here is through real estate investing, you get to qualify for what's called depreciation deductions, which means you get to make money in rent, have a profit, and then take a paper loss. This is a paper deduction. This is a paper deduction. That means you're not actually paying this money out of pocket. This is a deduction you get to take on paper on your tax statement, which says you get to take this write-off because your property is 1 year older. And in order to do this, please get a good accountant, because if you don't have a good accountant, well, you might not get the deduction and you might do it wrong and then have to pay penalties, fines, and interest, which is not fun. You end up losing more money when you do that. The second tax advantage with real estate is something called the 1031 exchange, which says, now, let's assume you own this property for a few years. And hypothetically, this property grows in value over the next 5 years to $400,000. Now you have a few options. You can just sit on this property, you can do a cash out refinance, or you can sell the property. So let's assume now that you go out and you sell this property for $400,000. Now you have a big gain. You're gonna have hundreds of thousands of dollars of profit on paper, which means you're gonna have to pay a big tax bill unless you qualify for 1031. What 1031 says is if you take all $400,000 and you use this money to go out and buy a bigger rental property, you spend all $400,000 buying more rental properties, well now, you don't have to pay a penny in taxes today. You were deferring all of these capital gains taxes. And the only time you actually have to pay those capital gains taxes is if, when you are living, you sell a property and then you don't do a 1031 exchange. So you could do this every 5 years. And you can do this until you die and never have to pay a penny in these capital gains profit taxes, because you can just keep flipping the property into bigger properties every few years. Now you can't be a real estate flipper and do this. You can't do this every 6 months. You have to own the property for at least 1 year, at the very least. And there's a lot of rules and regulations with 1031 exchanges with how fast you have to find new properties and how fast you have to close on the new properties. So again, if you're going to consider doing this, great. Just make sure you have a good advisor on your side, because there's a lot of rules and regulations that are involved. Which brings me to number 2, what are the tax benefits with stocks? The tax advantage by investing your money in stocks is you get to qualify for what's called long-term capital gains rates. Let me show you. James Quincy, who is abbreviated JQ, is the CEO of Coca-Cola at the time of me recording this video, and he's expected to make around $8 million in cash income. That includes things like his actual salary plus other bonuses, not his equity, but his cash income of around $8 million by running the Coca-Cola company. Warren Buffett is one of the largest investors in the Coca-Cola company, and because he's one of the largest investors in the Coca-Cola company, he also gets a lot of dividends because Coca-Cola pays out a dividend. And this year he's expected to make something around $770 million in dividends. It's actually a little bit higher than that, but around $770 million in dividends. That's cash payments that he's going to get this year just for owning the Coca-Cola stock. Now, the reason I'm saying this is not to show you the value of being an investor, but I want to talk about the tax advantages of being an investor, because James Quincy is earning a W-2 salary. He is an employee, and because you're an employee, you are what's called ordinary income. You're getting ordinary income, also known as earned income. And when you get this ordinary or earned income, you're paying the highest tax rates. These are the tax rates that I just showed you on the whiteboard in the beginning of this video. That means that the top tax rate for the CEO of Coca-Cola, because he's making a huge salary, is going to be 37%, like we talked about in the beginning of the video. But for Warren Buffett, even though he's making many times more than what James Quincy is, he's making this money as a stock market investor. And as a stock market investor, remember, you qualify for what's called long-term capital gains. So the top tax rate for Warren Buffett is not 37%, it's 20%, which means as a stock market investor, you get to qualify for lower potential tax rates even as you earn more money, because that's what the tax code says. And then the third type of tax advantage asset that I want to talk about are, of course, a business. I know many of you are entrepreneurs. And when you own your own business, you get to qualify for what's called the ordinary and necessary deduction. So I want to talk about that. The ordinary and necessary deduction says that you get to deduct expenses from your revenue before you pay taxes for things that are ordinary and necessary for you to run your business. So let's assume that your business makes $100,000 a year in revenue. And then you have expenses. Let's assume that you're selling avocados. If you're selling avocados, you have expenses. You got to buy the avocados, you got to pay the employees, you got to pay the manufacturing and the shipping and all that. So let's assume that those operational costs cost you $30,000 a year. These are those operational costs of getting the avocados. But then you and your business partner have to go and travel to different parts of the country and stay in nice hotels and drive a rental car and go to these places around the country, maybe even around the world. You have to go to Mexico, you have to go to other countries that produce the finest avocados. There's a cost to that. Now, if you are the CEO of the company and your wife is your business partner, and now you have to travel to Mexico to go look at avocados, that travel is a business expense. So now you could qualify for maybe $10,000 worth of travel expenses, depending on what your business is. Again, these are just hypotheticals. I'm not telling you what you can qualify for. You got to talk to an advisor to see what you can actually qualify for. I'm just giving you some hypothetical situations. So you and your wife have to go to Mexico to go look at avocados because your wife is your business partner. There's a travel cost to that. While you're there, you also have to pay for your rental car, which is included in this cost, which now is a deduction. But then you and your business partner and your staff have to go out to eat at some nice restaurants. Maybe when you travel, maybe you have clients that come over and you have to have meals with them. And now you have to have a cost to pay for those meals. And then maybe you need a laptop to run your work. You need a cell phone to run your business because you're on the phone with the clients. Well, these things are also a tax deduction as well. So that becomes a write-off for you. And maybe you need a nice pickup truck. Maybe you need a nice Ford Raptor to run your business because you got to put a whole bunch of avocados in the bed of your truck. And you have to go from manufacturing site to manufacturing site. And because of that, you need this pickup truck to run your business and to pick up these avocados and to distribute your guacamole. Well, now your payments, your lease payments, your financing payments, or a piece of the cost of buying the car if you buy cash, which is what I recommend as a financially smart person, buy that Raptor with cash. Well, now you get to also deduct your cost of the car, and I'm just gonna put $10,000. But then because now you have the cost of the car, you can also deduct a piece of your oil changes, a piece of your gas, and a piece of the wear and tear on the car, because these are things that you need in order to run your business. These are all ordinary and necessary expenses for your business because you need a pickup truck to run your business. You need that cell phone and laptop to run your business. You need to go to Mexico and see different parts of the world to run your business with your business partner who just happens to be your wife, who happens to be on your payroll. This is now where you can get sophisticated with the way you run and structure your business to also get the benefit of the tax code. Again, if you just go out and start willy-nilly doing this, you can end up in big trouble. You can end up paying fines and penalties because you don't know what you're doing. This is where you want to have the help of a good accountant who can help strategize with you and help you understand what the tax code says, because at the end of the day, the tax code is a rule book. And the people that win in the financial system are the ones that learn the rules of money. And I want you to learn the rules of money, because the reality is there are many different things that can be done, and it's all about how clever you can be. I'll give you one more story before I end this video. Sticking with this example, let's assume that you're running this guacamole and avocado business, and you also have to do a kitchen remodel in your home. You want to figure out, are there ways for you to deduct the cost of this $30,000 kitchen remodel, because obviously the home is where you live. Well, what if now you start creating content for your social media pages for your guacamole brand in your kitchen? You got to have a nice kitchen to show off on your Instagram and your TikToks, because that's what people want to see. And so in order to build the stage to shoot the videos for your avocado videos, you may have an ordinary and necessary expense in order to run the business, which is remodeling your kitchen in order to build the stage to shoot the social media content in order to keep running your business. Again, you got to be clever. And instead of you being clever and trying to read the tax code, get a good accountant who can help you understand the way the tax code works, because the tax code is a rule book and wealthy people don't understand it. They pay somebody to understand it. And so if you are building a business, if you're investing in real estate, and if you're investing in stocks, but especially if you're investing in real estate and building a business, get yourself a good accountant. And as you start to earn more money through your real estate and from your business, get better accountants who can help you strategize, because that can help you keep more money in your pocket legally. That way you can continue running your business and can continue growing your profits. When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this.